Good afternoon, everyone. I hope you're keeping well. This is the third of our weekly Zagga video updates. And given that last week we talked about how we assess credit on new deals and what the status of our current loan book looks like, we thought that this week it would be a good idea to perhaps take you through one of the investor memorandums that we put up on the platform. So I'm going to take you through an investor memorandum for a loan in Punchbowl, the Sydney suburb of Punchbowl. This memorandum will actually be put up on the platform next week. So because it's not yet fully final, you may expect a few changes to the document when it goes up next week. And also I've redacted some of the information in the document just so that that information is protected for now. Obviously, if you're an accredited investor and when the information memorandum is on the platform, the redacted information will be fully available to you. So what I'm going to do now is I'm going to share my screen with you, and I'm going to take you into the memorandum, and I'm going to explain to you exactly how the document works and to give you a sense of what it is you should be reading when you read one of these information memoranda. So just very, very quickly, there's always a header. Sometimes we put a picture in, sometimes we don't. The loan number is exposed. We tell you the return. Please bear in mind that that return is always net of any fees to the investor. So what you see is what you get. And this loan will have a loan to value ratio of 60.88% on the gross realizable value. The total lend is $2.3 million. And we've given this a Zagga credit assessment score of C4, which I'll talk about in a minute. As you can see there, this document is dated for the 6th of May, which is the date that we intend for this memorandum to go up onto our platform. So the first part of the document is always an information summary. And this summary generally includes some basic information about the loan and the credit assessment from our credit team. Now, for some of you who may not have heard this in last week's updates, I mentioned then that from a credit point of view, we have quite a robust credit process. And all loans, from a credit point of view, not only have to be signed off by our credit managers, both internal and external, but also have to be signed off by our directors' credit committee. So it requires those steps before the loan can go up on the platform. In the case of this particular loan in Punchbowl, this loan was funded previously by the Zagga Feeder Fund, and this is actually to raise the second tranche of the loan. So the full loan facility was in fact for $5.4 million. What we've done here is we've given an assessment over the loan. You can see that the project works are 47% complete. We've given you a little bit of information, and from our credit team's summary of the loan, we're reflecting the strengths of the project, which are set out over here. And as you can see, there's this important statement to say that the Zagga credit team has been provided with full support in documentation to substantiate the development costs, financial integrity, etc., etc., etc. That's an important statement, and we deal with that more fully in the body of the information memorandum. But most importantly, what we show you here is the Zagga credit assessment score of C4. Now, what that means is that the risk of default is unlikely, and the LVR is 61%. So from a Zagga credit scoring point of view, we rate the risk of default from A to F, and we rate the LVRs from 1 to 5. So C does not mean bad relative to A. It just means that the risk of default is unlikely. A, there'd be absolutely no possibility of risk. B, there'd be a remote possibility of risk, etc. So C is a very, very good loan. And in fact, most of our loans are either in the C or D category. And from an LVR point of view, the LVR is based entirely on the percentage cover. So if the LVR is under 20%, then this would be rated as a C1 for argument's sake. But because the LVR is between 60 and 70%, it gets a 4 rating. That's how we get the C4. We've also explained the rating is underpinned by our thoughts on the borrower and guarantor, about the site, about funding costs to complete, the progression and status of the development, and some information from the valuation. The next thing we'd show you is the net return payable to investors, which in this instance will be paid monthly in arrear. And as I said to you, what you see is what you get. So you're earning 8.75%. And the information memorandum will always tell you how long the loan is. So in this case, it's 8 months with a maximum of 11 months. And that if the extension period of 3 months is sought, the interest for that period will be paid on maturity. If the loan goes into default for any reason, investors will earn 11.75% per annum instead of 8.75%. And we'd need any investor's money by the 25th of May for those investors who are interested in funding this loan. Now, if you move then to the guts of the document, you can see here we have full exposure and full transparency on all of our information. There is the borrower's name. There are the names of the guarantors. Now, from a privacy point of view, when we deal with individual guarantors, we are simply not allowed by law to expose their name. So we never expose the name of individual guarantors, and we always quote them as individuals. We're showing you that we're refinancing the land and construction of a boarding house in Punchbowl. Obviously, in the final document, the actual address will be here. As I've said, it's the second tranche. There are the returns shown under rates. We've given you some information about the current status of the project. Works are 47% complete based on the QS reports. And all of this information can be read. Now, generally speaking, all of our information memoranda follow the same structure, but depending on the nature of the loan, they either have a little bit more or a little bit less information. From a Zagga point of view, the Zagga payments that have been made have all been certified by a QS. That's important. And we explain to you that the balance of funds will be used for construction, for contingency, total allowances, etc., so that you have a very good sense of exactly where the money is going and how it's going to be spent. From a security point of view, as we know, we always take a registered first mortgage. So we're taking this over the Punchbowl property. We have a first ranking general security agreement over the borrower entity. In construction loans, we always have a tripartite agreement between ourselves, the borrower, and the builder, which allows us as lender to step in and either to put in place a new builder or to take over the instructions to the builder. And we have individual guarantees and indemnities given by the individual guarantors. The loan term is set out and explained quite clearly, together with how interest is going to work, as well as the loan amount. So as you can see there, this tranche is for $2.3 million. It's actually the second tranche. The funding requirement was for $5.4 million originally. We always show you how the loan is going to be broken up, what the funding table looks like. So as you can see here, the full debt, including interest owing, is $5.4 million. And remember that our loan to value calculation takes into account that $5.4 million. Then we show you the construction funding component, the interest and line fee component, the platform fee of 1.65%, which is the fee that will be payable to Zagga Investments for putting together the loan, and the brokerage fee that will be paid to the third-party broker who sent us the loan. Less legal fees, the monthly charge by the QS, which is not a cost that any of the investors bear. This is a cost that the borrowers bear as part of their construction cost. Because this is a construction loan, we've given allowances for rates and taxes, for council contributions and authorities, and for project consulting fees. Obviously, if this was not a construction loan, then you would not see those kinds of fees in the funding table. And at the end of the day, there's $1.25 million in free cash available for the borrowers. We've explained how the loan to value ratio is calculated. In this instance, it's 60.88% on the gross realizable value. This was based on an original valuation in September 2019. And since construction has started, the then increase in value based on all the QS reports. And if you remember a little bit up in this document, we showed you all the QS payments and information. We explained what the repayment strategy looks like. Repayment strategy or exit is a very, very important part of our credit assessment. And in fact, we generally will not get into a loan unless we know how we're going to be able to get out of the loan. And here there are two options for exit or for repayment. In this instance, because it is a construction loan, and as is the case with all construction loans that Zagga funds, we have our own quality assurance consultant, CCPA, who will have oversight and who will in fact sign off on all drawdowns before Zagga pays any amounts away. We always try and give some information about the developer and builder, which we've given over here. Again, we've redacted certain sensitive information just for the sake of this video, because a lot of people who see the video are not necessarily accredited investors, and we can only show this information to accredited investors. We have standard conditions that apply to all of our loans. These are the standard conditions that are set out over here. And we've then also given you some financial information. In this case, we've explained exactly what information we've been given by the borrowers and the guarantors. And we've noted that they have a total net asset position between the borrower and guarantors in excess of $18 million. And remember that that is underpinned not only by a general security agreement, but by personal guarantees in addition to the security property. So we feel that the exposure here is very comfortable, and in the event of the property not holding its value for whatever reason, there'll be no difficulty in recovering from the borrower and from the guarantors. This CC Property Advisory points of recommendation is the recommendation from our external credit team. So in addition to Zagga's own internal credit process, our external team tells you here why they think that the loan is creditworthy, and they deal with their various points of recommendation and risks. And then the last point you'll see in all of our IM documents is the funding and timing. So as always, there's a minimum investment of $100,000. We require funds into the Zagga account, the trust account, by the 25th of May. We note our interest will be paid. Investors will earn 8.75% per annum and payable monthly. And if the deal goes into default, investors will receive 11.75% per annum, again, paid on maturity. So the way that the process works from now is that once this information memorandum goes up on the platform on the 6th of May, it will be matched to investors. If it's not matched to an investor specifically, an investor can still go in and find the memorandum on the platform. You've just got to go look under the loan book or under opportunities, and you'll be able to find the document there. If an investor is interested in funding this loan, then they simply have to click on the loan in the portfolio, click on the documentation, and there is an opportunity there to fund the loan. So I hope you've got some value. Random works. We thought it would be a good idea just to take you through it and to help you to navigate it, so that when you next see an information memorandum, you know what to look for and where to read it. I suppose the 3 or 4 key points to remember in this regard are: firstly, there's always an assessment by our credit team. Read the credit assessment score from Zagga and understand how that is put together. Secondly, bear in mind that all of the documentation is transparent. We disclose the amount paid by the borrower. We disclose the amount to be received by the investors. We disclose all fees and charges. We put as much other relevant information into the document as we're allowed to share based on privacy and legal requirements. And of course, we give you the opportunity and tell you what you need to do to invest in the loan, should you want to invest in it. That's all for now. We'll be back next week with something else of interest to talk to you about. As always, take care, stay safe, stay home, and together we'll beat COVID-19. Bye-bye for now.